Retirement plans and health savings accounts, right? These are great ways. A lot of investors don't like retirement plans. They don't want to take money off the table to put, out of their real estate money pool to put into retirements. But I mean, if you're a broker, if you've got business income now, this is I'm using this is an old slide evidently because I'm using 2022. That number is now up higher, maybe 60 some. It's higher than 61. It's 66 or 67 maybe for 2024. Well, you can put away a lot of money in the right retirement plan, right? And like we talked about before, you can use your retirement plan contributions to get your income below the $150,000 so that if you're an active investor, you can take the rental losses, and that's a double dip. That's a double whammy. You really want to try to take advantage of that strategy. You also want to make sure you're doing your health savings account, right? You're making if you have high premium insurance, like a lot of us have, then you want to make sure you're making that health savings account deduction. That's a good one. It could be $7,000-8,000 for a family, right? So all of this stuff adds up, right? Cost segregation is a huge hit against your income. But most tax hits come in dribs and drabs, right? A little here, a little there, right? So if I had a rate them, as high as to lowest, cost segregation is always going to get you a lot of tax savings. Retirement contributions are always going to get a lot of tax savings, but you also got to pay attention. You got to be granular. You got to you have to pay attention to all the little stuff too, because if you save, if you don't miss some of your admin expenses and you save another couple $1,000s, and you don't, and you make sure you make your health savings contribution, might be another couple $1,000s, and you time some of your expenses a little better. That's a couple more $1,000s. All of a sudden that adds up. Now you've saved $6,000, $7,000, $8,000, right? It's a great strategy. So you have to be granular with that stuff, and I always advise people to put money away in their retirement plans. A lot of people don't. I think it's a mistake. Traditional versus Roth, the difference for those of you who don't know, a traditional plan you deduct is a tax deduction when you contribute it, but you're going to pay tax it grows tax free, but you're going to pay tax on the money coming out as you take it out when you get older, right? A Roth contribution, you don't take a tax deduction. When you put it in, it grows tax free, and you don't pay tax on the money on the way out, assuming you don't take it out for at least 5 years, right? Now, I highly recommend Roth contributions for young people. I think it's a great way to build tax-free wealth at a time when you are young and you have a long period of time for it to grow, and maybe your income isn't as high, right? Whereas once people get a little older, their income tends to go up. That's when you really should be making the deductible contributions, because you're just getting that much more of a deduction, when you're in a high bracket. Okay.